Boom. So I sure that you probably have been hearing, seeing, and like over inundated around this whole recession talk. A lot of people are feeling that we are going into a recession, even though I talked about this at the top of last year. When we were coming out of the pandemic of a sorts. And technically, a lot of people don't know that we had a recession in February of 2020. We couldn't see it in 2020. If you get my pun, you understand. The whole thing around the recession talk is that you will hear, oh, we're seeing an inverted yield curve. Here's what that is. Or we're seeing this happen with inflation being at the 40-year high, 30-year high, gravitating towards what we could deem to be a deeper recession. And interestingly enough, I call it like a economic shift. The reason why is because people compare it, and I talked about this in my Substack, that people are comparing the sentiment that we're seeing, in 2008, 2009, that iconic recession in itself, and saying, oh, it's the same. But like I called out in my Substack, that we're having the sentiment or feeling of the 2008, 2010-ish recession, but yet still the situations that we are seeing with SVB Bank, with inflation, with jobs, and what we're seeing with AI, artificial intelligence. I love it. I'm pro AI, but yeah. But we're seeing situations such, even the housing market. Let's not even get into that. But we're seeing the sentiment or the feeling that we had in 2008, 2009, due to pretty much a trauma bond or PTSD, pandemic, PTSD from that. Yet, it still are seeing situations that are remnant to what we saw in the 1970s, 1980s. No matter if you are a 50s, 60s, 70s, 80s, 90s, 2010, 2000s, whatever, baby. The thing that we've been seeing right now, it really has no main focus. Honestly, the thing that I have been saying throughout this pandemic is that we can only learn from previous situations as cliff notes, meaning we have what we saw happen in 2008 to say, hey, how can we prepare for it now? But it's no copy and paste. Just like we saw in the Great Depression. It's no copy and paste that we saw in the Great Depression that happened in the 2008, 2009-ish era of that recession. But interestingly enough, the way that we saw it took a long time for the Great Depression to be called. We saw it take a long time, roughly a year or 2 years, for the 2008-ish recession to happen. And then if you notice, during 2020 that we saw stock market did roughly crazy things, supply chain did crazy things, but yet still nobody really called that recession. And our happenstance, feeling that the fact that we didn't really call the 2020 recession, yet we're seeing it's still slow roll now, that technically what we're going to be deeming as a 2023, 2024, I'm going with my gut with 2023, recession actually started back in 2020. During this recession, economic shift, or whatever, is that you still can stack and mac. I had to play off words, to actually thrive during what can be uncertainty for not only the group economy, meaning the world, the U.S. world economy, but also your personal economy. Because one of the things that I called out is that everybody's hyper focused on the collective recession, but yet still people getting laid off. People are having to still find a way to afford their life due to inflation going up. So in actuality, that we're seeing recessions happen for people in different spans. So because the same way that we saw that a recession happened in, and was it the Great Depression, the 70s and 80s, I have been really hyper focused on calling out that 70s and 80s era of recessions to what we potentially could see the peak of going into what we could be seeing, that we also, to go back what I was saying, I lost train of thought, but I really wanted to get hyper focused on why I have been really calling what we're seeing as the offspring of the 1970s, 1980s, 2000-ish recession that we're going into, or economic shift, whatever you want to call it. The reason why I really wanted to be fixated on talking about it is because we've been seeing commentary on how to prepare or how to do this. I'm gonna say something. No matter how much preparation that you do, it's gonna probably feel not enough. But the caveat to it is that I want you to be very adamant to know that the work that you do, it seems like you're doing a lot because you are, but you're going to build towards something that's going to buffer you, granted, if you didn't prepare. One of the things that I called out in one of my videos was the emergency, breaking in case of emergency, is that imagine if you didn't have a life vest when the actual accident happened, like on a ship, or in a car. Like, what if you didn't have that seatbelt? So while I am saying that, even if you feel whenever you get into your own personal recession, if it happens, or we do see the cluster F, like I posted on Facebook the other day, that we could potentially see with this economy, I sort of made it rhyme, is that there are some things or mistakes that we've seen from previous recessions. I mean, we've lived through the 08 recession that are kind of like those mistakes that people tend to make. And I really wanted to talk about why it's key to understand, here's the mistakes that you could potentially make, but then what can you do to make sure it doesn't happen to you? The reason why I'm saying that is because this recession that we're walking into, or moonwalking, is not necessarily going to be the stereotypical recession. And I really want people to plan it, not panic when it comes to making sure that they're prepared at the best possible rate that they could be. And I don't want people thinking, oh, I seen this article saying how to prepare for a recession, but it didn't really give me no context. And that's one of the things that I have been finding and I have been calling out, is that people write these articles, but they don't fully give you any instance until how to actually align for whichever they're talking about in that article. So in my guide, Plan It, Don't Panic, I give you 10 mistakes that people actually do make when it comes to preparing, or well, not necessarily preparing, but not preparing enough to handle a personal or a mass recession. The reason why I picked 10 is because technically I noticed that when I went through my own thing, being unemployed for 4 years during the 08 recession, having to budget with food stamps, having to figure out how to pay bills, withdrawing from my 401k. If you've been following me on any form of social media, you know that I have talked about how I have pretty much drained my 401k back at my job during that time. That was the first job I had out of college. I drained my 401k because I was waiting for my severance to hit, which is only 2 weeks, and waiting for the mass people that would start to get on unemployment and being backlogged. So I am sharing these 10 steps. Well, I'm going to talk about a couple of them here that I have noticed that I have made, or other people that I have seen made through their recession, or their recession, as well as the recession that we've seen at a mass. So the first one that I want to call out is ignore your emergency fund. The reason why I've talked about this in previous content and video is that people talk about, creating a sinking fund and multiple ones. So pretty much a sinking fund is this. But the theory around it is that if you are building your emergency fund, you fully have to understand how much does your life cost. When you understand how much your life costs, you're able to cultivate the actual product that you may need. You may need to put I suggest that you put your emergency fund into a high yield savings account, but you also need to have some money into a regular savings account in case some shit happens. The reason why I am calling this out the way that I am is because in the middle of a recession, if you're noticing that you are you're having a gap or a money gap when it comes to your income to debt or bill ratio, no pun, is that if you have your mortgage or your rent due and you have all of your emergency savings over into a high yield savings account, and high yield savings accounts take between 3 to 5 or longer to transfer over to your checking account, you're not going to have that surplus able to pay your rent by the 6th. Oh, I keep it real over here. You're not going to have the money together to pay the gap that you have for your rent comparisons to what actually is due. So the theory of it is that you hear about, oh, you should have 9 to 12 to 24 months of savings. That's true. You should. Because honestly, what we're seeing with this economy is that it could potentially last a long time. Granted, have we even recovered from the 2020 recession? But the theory that I like to give that little interlude. The theory around having those 9, 12, 24 months is because you don't know how long a recession could last, or we don't know how long we're going to be unemployed. You heard me recently talk about that I was unemployed in 2010, because you notice it happened in 2008. I got laid off in 2010. That I was laid off for roughly 4 years. Right. So we don't know how long things are going to go. And then the fact that we're seeing more people getting laid off, not only in tech, but it's just happening. So for you to understand and to manipulate your money to actually have it in case of emergency is that you cannot ignore the fact that you have to have an emergency savings for emergencies. That emergency is not necessarily just in case your severance or your stacks ain't hitting. It could also become an emergency if you have a car issue or you have some medical debt that come out of left field that you thought insurance was going to cover and it didn't. Emergency looks different for different people in different situations, but having two different forms of a sinking fund is going to be cool for. Is it going to be the accumulation, meaning it's going to be a high yield savings account, or is it going to be just the accessibility of a regular savings account? But the reason why I'm calling accumulation and accessibility is because with high yield savings accounts, you're going to get a higher interest rate than you do with a regular savings account. But on the accessibility, you're able to get those funds quicker than you do on the high yield savings account. But you can easily, when you notice that these shoes are on sale, move money out your savings or your sinking fund in your regular savings account to be able to purchase that. So it's also the discipline and the designation that you have for your savings. The next one is not fully understanding your expenses. The key for you to build and prepare for a recession, personal or collective, is that you fully have to understand where is your money coming from, how is your money flowing out, and which way is it flowing. The reason why I'm saying is that I always tell people you can't be budgeting the same way that you do now that you did last year or the year before that. Why we're seeing things go up due to inflation. The route is we understand the inflation a lot. We're noticing that car insurance is going up due to inflation, and I'm confused because nothing has to do with you. But that's the theory, is that you pretty much have to get a grasp of your expenses, determine how does it fit within your budget, and then determine how can you actually go back to number one, actually start saving for your emergency fund. Then determine how am I on par to build a skeleton budget just in case my income that I'm used to now changes to a different income that I don't have anymore, to the new income per se. And it's the thing, like I called out a second ago, is that you have to pull your receipts, meaning your bank statements. I know you don't want to look at them. I'm grateful that banks have to go back 7 years of bank statements for you to have on file. But you have to go and determine your budget to see, okay, what have I been spending this month comparison to the months before, and noticing maybe you are getting hit with the inflation. Maybe you might need to start curving your budget. The theory around it is that for you to better understand and to build a budget, you have to fully understand where you are and how you can handle any uncertainty. So yes, I could tell you how to cut back, but if you don't understand what are you cutting, how can you actually be precise in the slice? That's all I have about that. But the thing is that I didn't prepare for my recession then, or even when I got laid off from my job a couple years ago, is that I didn't understand. I was able to handle it better due to the initial layoff. It's because I was able to fully say, this is what I didn't do well, and this is how I can leverage it. You know, I love to say, leverage that L, that loss, or whatever you had, that so you can leverage to handle the situation in case it comes back again. Another thing that we have been seeing countless conversations about when it comes to recession is that how are you understanding your income streams? Are you just relying on your paycheck that you have from your job, your 9 to 5, your business, if you are a small business? What are your income streams? If you are only relying on one, you're not, it's going to be very critical for you to actually start including different ones to buffer, just in case that one gets slacked a bit. And especially what we've seen during the pandemic, granted, I wasn't able to get a PPP loan, but please understand that time I was able to determine that I needed additional income streams. So for me as a business owner, maybe it was digital products. I was just only slowly relying on sessions, coaching sessions, but I wasn't building out affiliate marketing, speaking, and things of that nature until the pandemic presented itself. But for people who are not business owners, it's that if you're just relying on your 9 to 5 or 9 to 6, that you're going to have to start looking into leveraging what income streams actually match for you, how much they actually cost to start up, how much can they bring in, so you determine what you might need in the meantime, and what actually could that buffer of an additional income stream be. Is it going to be passive, or do I have to be active in it? Such as you doing gig economy, such as DoorDash, Uber Eats, or Ubering, whatever. Or are you going to have something passive, such as vending machines or real estate, Airbnb? I know Airbnb is going through it, but finding those key ways for you to find an income stream that's going to either be passive, meaning you don't have to touch it, or you can be you have to be aggressively working through it. But the thing of the matter is, when people talk about income streams, is that they don't say how much it actually costs to start and how much it's actually going to cost to upkeep. Because you could be looking at the revenue portion of it that's going to bring in, but how much does it cost to upkeep? If you are starting another business, how much, or a side business or freelancing, how much does it cost to actually make it run? And what's going to be the ROI over to that? But for you to actually understand the ROI, you have to fully understand the rate of your income stream. That's the key thing I want people to get when it comes to that. So the notion that we've been seeing from the top of the pandemic, with so many people getting into the gig economy, to understanding how much can I actually make? If I am door dashing, how much gas do I have to use to actually generate this amount of money? And then and so forth and so forth. So it's not bad if you have one income stream. How much money is it going to take to make some more money? Like Jeezy said, if I have a 9 to 5 and this is an income stream that I am considering, how much money from my main one is going to flip to this one? It's going to actually flip to another funnel of money for me to keep my life together in case this happens. Or if it's nothing was to happen, that I'm cool with it actually going to paying down debt, to buying additional assets. So it's not necessarily having an income stream to help just in case of emergency, but to help to build a case of generational wealth that you can potentially look for down the line. So that's why it's very key for you to make sure that you're just not relying on your 9 to 5, that you're finding something that either can be 5 to 9 or 24/7. But even though you still have to continuously grow it, this to say, okay, I got this one, so this is what this next one is doing, so what's the other one? It keeps rolling, but you figure out your formula as you develop it over time. The next one that I want to talk about is not investing. I've been seeing people saying that they have stopped contributing to their 401k. They're not they're not investing in the stock or crypto markets. But the theory around is that for you to, what's that song? Don't Stop Believing. That's what we're going to apply for when it comes to this whole period that we're watching of volatility. This is what volatility means right here. This because you're noticing some toxicity when it comes to investing or any of the stock, crypto, real estate markets. That does not mean that you should stop. That only means that you have to shift your risk tolerance to understand, okay, I'm okay when the stock market was cool, but when it got to March 2020, I didn't like this, and this. And this is the kind of funds I need to either funnel into my retirement, my brokerage account, my exchange, for those that are in crypto, or to the real estate side. Maybe you noticed it was too risky or you banked off of real estate during that time, but you also are starting to align to REITs, which are real estate investment trusts. So like a stocks aspect when it comes to real estate. But the thing of it is don't allow the volatility or the toxicity that we're seeing in the economy and the different respective markets to make you stop. Make it allow you to shift your risk tolerance to say, okay, I don't want to buy a lot of individual stocks, but I do want to still invest. And I'm noticing that within all of my portfolio, these funds have been doing well. These funds have not. I'm going to research what funds have not been doing well and potentially look to an ETF that aligns and has been seeing gains and staying steady, even though it's been volatile. So the theory of it is that you have to say, okay, maybe I can't invest this amount that I was doing, but the amount of money that I do find that I can invest, I'm going to buffer that over into these more risk relatable or responsible things due to the fact I can stomach this. I learned about my risk tolerance during the recession of 08, 10, whatever, because I had to drain my 401k, all the funds in it and everything to actually stay afloat. But within me rebuilding it back, it allowed me to see what funds actually were in there that were performing well and which wasn't. So whenever I started to rebuild my retirement, that I'm able to gravitate from that information and say, these funds did well, I was okay with this, and this is what I researched about them, and this is how I am rebuilding my retirement, which I have done so probably about 10x from what it initially was. But the theory around it is that shakeups are going to happen, and that should not make you stop actually building wealth. The thing that it should do, though, is for you to understand, okay, if I can't invest as much as I want, maybe I can't buy a house. I'm going to go to buy REITs. Maybe I can't buy a full share of Tesla, but I'm going to go buy this ETF. Maybe I can't invest in this. Let me do something of that. Maybe I am scared and I need to research different companies, some, but like I called out in my course, that you're actually you're putting money over into you from you're automating it from your regular account over to your brokerage account. So whenever you do notice that company goes on sale, and it's within your target, that you have the money there, that you're not pulling from your budget to actually move to buy something. So it's a whole theory around but as they called out during the 08 to the 2010 or whatever recession, is that millionaires are made in there. I don't just want you to focus on becoming a millionaire. I want you to focus on building the means to have the life that you want, regardless of what comes from this economy. That's the key thing I want you to focus on. But I don't want you to not invest, period. Heck, I even didn't call out crowd funding investing. You still could these companies need checks. You could be an angel investor and make only contributing $5,000, $1,000 checks to these companies that you believe in and have researched in. You can still be investing. Heck, crowdfunding platforms such as Start Engine and Republic, and I forgot Refunder, 200, 250, some even 100, depends on the valuation, but don't stop investing. So for you to get more tips about what mistakes not to make during a recession, check out my guide. Plan it, don't panic. 10 mistakes not to make during a recession. I don't just give you, oh, these are the checklists. No, I give you things to get in check so you won't actually make those mistakes. So drop in the comment section to let me know what questions do you have, not only about the recession, but your money topics or even your business topics. I'm sorry talking about that a little bit, but I really wanted to focus on this recession talk before we start seeing shit hit the fan a little bit more. So check out my freebie, check out my website, even check out my Substack. I'm going to be been unloading a lot of content there. So let me know, how are you planning to plan it, say that 5 times, during this recession whenever it's coming, and it's coming in sometime soon, so you don't have to panic whenever shit hit the fan. Let me know. That's it. Bye.